I want to start not with a fairy tale, but with a kind of story that many of you have read to your children or your grandchildren. We'll call it a Pooh Moment. And as you can see, there are two characters here. The first character is Eeyore, and we know that Eeyore is kind of a depressed, gloomy individual, somebody that would worry about markets or the economy or jumping the shark or things like that. Whereas on the other hand, Pooh is a very happy individual. And I thought that these images would be a little more correct than me being in a bubble bath. So I then today was looking into doing a little extra research on the characters, and I found out a little bit more about Pooh. It seems, according to Wikipedia, Pooh is extremely naive and slow-witted. So these are not actually characteristics you're looking for in a financial advisor. So I am rethinking this image, and I might come back next year as Tigger. Now, Rob mentioned the Happy Days image, and I want to talk about a couple of things that aren't necessarily particularly happy. First is higher taxes, and the second is depressed markets, at least as they were until the end of February this year. Now, since then, we've had a budget that actually seemed to give some reprieve on some of the most onerous tax suggestions that have been made back in December. And obviously, there's been a recovery in markets, whether it's a dead cat bounce. I'm not sure you're familiar with the image of a dead cat bounce. Hopefully, most of you have dogs and you don't looking at this personally. So I realize that as a result of the fact that I'm going to have to deal with some things that are also a little gloomy, that I might have to go over to the dark side with Rob and change my image. So for the first part of what I'm going to be saying, I'm going to be a little closer to Eeyore. So let's talk about the higher taxes. Back in December, the federal government announced intentions to change tax rates, and they brought out tax changes that applied in January, including lowering the tax rates at the middle income levels, but increasing it by 4% at the higher rates. So luckily for people in BC, a surtax that applied before of 2% was removed at the same time in January this year. So the overall tax on the first $200,000 of income is now lower. TFSAs were then reduced to $5,500. There was no income splitting of salaries. That was disallowed. That was something the Conservatives brought in. And initially, they were going to start taxing stock options over $100,000, and they were going to change the structure for incorporated professionals in particular to make it more difficult for them to operate as a small business. And finally, there is an actual increase on corporate tax rates of 4%. So the idea is to very quickly go through some of this stuff and sort out what means something and what doesn't. Now, the two things that were not included in the budget, which were a bit of a surprise, the reprieve, if you want, were the stock options and the fact that they haven't fundamentally changed the rules for incorporated professionals. So let's take a look at the salary compensation issue. In Canada, if you run a business, you're an incorporated professional or a business owner, you pay 13% tax on your first $500,000 of income. Typically, you come up with a compensation model with your accountant to split dividends or salary in some way between yourself and your spouse. You pay taxes in CPP. Whatever you're not spending can go into an investment company, but now your tax rates on an investment company can be as high as 50%. So there's a bit more to this, though, than meets the eye, because right now the tax rate on interest income or foreign dividends in a company is 50%. It's 38% on dividends from Canadian companies, and 25% on capital gains. So if you just look at this picture as it is, in a company, you could be paying each year tax of almost 40% on your portfolio. But like most things, it's not the entire story. So there's something called, well, we call it air miles. It's actually RDTOH, which stands for Refundable Dividend Tax on Hand. Very important you remember that. There is an exam after this is over. And that says that we'll give you a refund, a significant refund of 2/3 of the taxes you pay us on your investment portfolio, as long as you pay a taxable dividend to somebody. So let's take a look at how that might work. If we actually got that tax back, our tax on interest would be 19%. Our tax on dividends would be 0. That sounds a bit strange, but if you own shares in, say, the Bank of Montreal and you're getting a 5% dividend, and you're getting back your refundable taxes, you pay no tax on that dividend inside a company. That wouldn't be true personally, but it is true corporately. And capital gains would be 9.5%. So now my 40% roughly tax rate has gone down to less than 10%. And if I put more of my investments into interest-bearing pools such as RSPs, IPPs, TFSAs, or insurance policies, I can probably get that tax rate down to 6%. That part of the budget, even though the initial rates on corporate investments went up, this part has not changed. So let's say I want to get some of that RDTOH back, and I have a son or daughter going to school, and they're over 18. I pay them a dividend of $33,000. They pay no tax on that income. In fact, depending on how much their tuition is, it could be a lot higher than that. I would get back $12,600 in corporate tax that I had paid on my investment portfolio when that transaction takes place. Let's say I choose to take a dividend as part of my compensation. If I do that, then I would get back, depending on how much tax credits I had, $76,000 in tax credits, but I would only have to pay, or a couple in this case would have to pay, $31,000 in tax. In fact, if they're entitled to what is called GRIP income, that is if they're earning more than $500,000 a year in their company, the tax would actually be $15,000. So there are very interesting ways to integrate active business income with passive income. It's not important that you remember all of the details regarding this here, because that's not likely to happen. But you can come and talk to us or your individual advisor here, or obviously your accountant, to see how this now works for you. So if you have less than $500,000 a year of income, in an ideal arrangement, all the dividends, all the after-tax income would go directly to a holding company, which in turn would pay dividends to a family trust, and the only compensation the individual would take out of the company would be in the form of dividends. So to make it really clear here, there's no advantage in this person, in this situation, which applies to a lot of incorporated professionals and small business owners. There's no advantage in taking a salary, and there's absolutely no advantage in buying an RSP at all. The most tax this person can save by buying an RSP is 13%. So they're going to pay 2 or 3 times that in tax when they start to take the money out. Now, what if you earn more than $500,000 a year? Well, that situation now is different. So let's compare the two between salary and dividends. So I've put a salary in here of $141,000 a year because that's enough to maximize an RSP. So we'll put $25,000 into an RSP. We're going to have to pay $34,000 in tax, and we're going to have $81,000 to spend. So let's see how this looks if we're now earning more than $500,000 a year and we take dividends instead of salary. Well, the income pre-tax is the same. The tax is quite a bit higher at $42,000. The spending, if I only spend $81,000, it leaves me with only $17,000 in savings, as opposed to $25,000. Net result here, I'm paying 23% more tax, and I'm going to have 25% less retirement income because of the fact that I'm accumulating, not only on a taxable basis, but I'm accumulating less savings. So in this case, the rule of thumb is simple. If you make more than $500,000 a year, you should pay a salary to maximize RSPs or IPPs, and then you should pay dividends to get back the refundable taxes on investment income. So that's a very short summary of what's in the budget. Most of it actually was not bad news. Mind you, we haven't seen them do their worst yet, so they still have 4 more years to see what they can accomplish.